The market finally starts breaking away, but the thing is going 100% the opposite direction you thought it was going to go. Well, isn't that just wonderful? Why did it do that, right? Were there clues that could have helped in better understanding what's going on? There just may have been one or a few hiding in plain sight between the candles that you might not have known about. Hey there, John Henry here, SSFTG. I hope your trading has been impossibly profitable so far. Hidden close candle gaps are a type of gap that present themselves in the market all the time, but most traders gloss over them or don't even notice they exist because of how small they are, hence the name hidden. I'm going to be breaking down everything to know about HCCGs in this video and an awesome strategy at the end, so make sure to stay tuned so you don't miss it. Speaking of not missing anything, now is a good time, or at least as good a time as any, to subscribe to the channel and like the video to make sure that you don't miss anything that comes out from us in the future. HCCGs are, as the name implies, a very small gap revolving around the candle's closing price and compares it to the following candle's open price and where they both land. In most cases, when liquidity and volume are solid, these prices should line up with each other. A bar closes at 44.50.50, it should open at 44.50.50 on the next one. A hidden close candle gap then takes place when price from the close does not line up with the open of the following candle. Instead of opening at 44.50.50, it opens up at 44.50.75, creating an expanding gap, or 44.50 quarter, creating an overlapping gap. This slight bump in price can be a big clue in the overall structure on what the market is trying to do behind the scenes. Candle gaps like this are something that I use very frequently and something that I use quite often even with my VIPs in the live trade room. If you would like to join me in our private VIP live trade room every single trading day from 9 a.m. until lunchtime, Eastern time of course, you can get more info and register for a 1-week trial on the main page of ssftg.com, and you also, along the way, get our guide on risk reward totally free included when you register. As a trend continues on, it will begin to demonstrate expanding gaps. You would immediately think that this is an amazing thing, right? And it can be in the short term, but this is almost always a sign of the expansion cycle nearing an end and a pause or pullback is near. You've got to be careful because this can be a warning sign. Again, an expanding gap would be a candle closing here and the next one opening here, right? They expanded to the upside. There is a gap between the close and the opening of the next candle. As the trend continues on, it will also have pullback phases. If a pullback is healthy, it will almost always have some sort of overlapping price action, demonstrating that price action is getting aggressively swept up by traders right as the candle is closing. Another contradictory one on the surface, but it reinforces the likelihood of it being a continuation in the preceding direction. As an example, and again, just so that we know the difference here, an overlapping type is like this, where it gaps down over top of the previous candle. Now, it goes without saying that nothing is ever 100%, of course. In some markets that are less liquid or have less volume actively trading in it, will have more of these gaps. The S&P 500, or the ES, which is the chart that we're looking at here, is a massively liquid market with anywhere from 10 to several hundred contracts on every single price point. This means that it's a lot more difficult for gaps to form, and because of that, are more impactful. A penny stock in the pre-market will, on the other hand, have these gaps everywhere because it's just not as liquid. They aren't exactly hidden gaps at that point. Now, scalping HCCGs can be a very interesting way to approach the market and allows for some incredible areas of interest even for swing trades. One of my favorite scalps with this concept is to fade overlap pops against the trend and to fade expanding gaps for a mean reversion back against the trend. Let's take a look at a few candles today to show you what I mean here. So a really good example, if we zoom in really close here to see what's going on, and we're looking at each individual candle gap. The market is driving down, and if we look at the closing price versus the open price, you'll notice that there is no overlap. There's no gap. It's a perfect close to open. Same goes for here, perfect close to open. We go to the next one. Now we have a little bit of a negative gap. Now, do you remember what that overlap gap tells us? It usually means that even if this is a small pullback, it's likely going to get continuation. So the fact that we had this little bitty inside pullback in a weak bear bar, that little clue right there might have been good enough for the sellers to continue and drive down for the next candle. But what did the next candle do? Well, interestingly enough, right after the sellers were given some reinforcement, that reinforcement was immediately taken away with an expanding gap. Now remember, expanding gaps mean that the trend is usually closer to the end. So when we have an expanding gap closing down while the market's moving lower, chances are after this candle closes, we're going to start seeing some bouncing. And that is exactly what took place here. Now, after this big sturdy bull bar, we don't see any gapping on the bottom, and if we go into the next candle, we also don't see any gapping. There's no distances, there's nothing going on here, nothing saying that anything's wrong yet. We have another candle, and now, here again, we have a gap down. Now, notice what this gap is doing. Bear bar, and the bull bar opens lower. This is an expanding gap. Now, if this is an expanding gap, what does that usually mean? Well, an expanding gap usually means that the trend is closer to the end. What trend was it trying to do? Well, it was trying to resume back down again. It was bearish, and it failed. So it's very likely that the bulls look for a continuation phase to try to get things going back up. Here we have a nice strong bull bar. Now look here. We have some overlapping. Now, what does this overlap gap mean? It means that if there's any pullback, the next pullback is likely going to get gobbled up. So buyers will be looking to buy internally within the body of this candle to keep it going. It didn't even pull back at all. None. The buyers were too aggressive, and they kept sweeping it back to the upside, and now we have no candle gapping again. We're kind of back to par, and we know that the buyers had a chance to get aggressive, but they kind of got missed. As we continue further forward, we have a bear bar back down, and notice we have what? We have the close of the candle here and the open of the next candle here. That is an expanding gap. That tells us that the trend is likely down. What is this trying to do? It's trying to go lower. Well, if this is telling us that there's underlying weakness, this probably isn't going to work. And if we look backward as to where this is coming in, it makes sense. This is where all the buyers wanted to buy in. It's much more likely that the bulls bounce this back up off of this zone. And that's exactly what they do. They bounce it right back up again. Now, immediately on this very next candle, what do we have? Right? We have the close to open, expanding. What's the market trying to do? Trying to go up, but it's expanding. There are some problems then. It's much more likely that this runs into some issues, at least from what the underlying is telling us. It might not look like it, but there is underlying weakness here that should push the market back down. And there's the underlying weakness. So you get the idea here. These are something that can give you a huge clue. I hope this guide helps you understand both what hidden close candle gaps are, as well as how I like to use them, and hopefully the examples help drive the point home even further. Is this a strategy by itself? Sure, I suppose it could be, but let's be real here. Scalping without understanding the psychological backbone at the time is asking to get ran over. If the context is right and the location is solid, can this be a good setup? Definitely. This can be an incredible setup that picks up possibly even the lows to within ticks, but context is key. If you have any questions or topics for other videos or anything else, get them in the comments below. I love hearing from you all. Thanks for watching, and we'll see you in the next one.